Now, the Centaur Flexible Fund was launched in December 2004 in partnership with Metropolitan Collective Investments. Centaur Flexible Fund strategy is to weigh up the risk and rewards inherent in the current share price of a listed company before making an investment. Roger Williams, portfolio manager at Centaur Asset Management, joins us in studio for more on the group's investment strategy. Are you generally positive right now or more bullish? I had Glenn Silverman and Paul Hansen on the show last night or the night before, and a bull versus bear debate. And I think Glenn actually won through with his bearish sentiments on the world right now.
I'd say I'm more neutral. I think we've, off our lows in 2009, the market's really performed exceptionally well. I think it's almost doubled. I know my fund's more than doubled over that period. And, things are at quite a high level. But having said that, what's very important for the direction of the stock market is interest rates. And the news generally there is actually quite positive. Inflation, I think, has been lower than people have anticipated. And also maize prices, wheat prices internationally have been falling, and so has the oil price. So that is a positive factor.
So no inflation right now creeping in, or no scary inflation creeping into the system?
Well, the negative is the rand's weakened quite a lot, and that will feed through. But I don't see a massive
deterioration in the
deterioration. It may actually be lower than anticipated. I, for one, was expecting inflation at this stage to be a lot higher, maybe over 7%. It's sticking around 6%. With the lower oil price, it may actually be coming down. But then on the negative side, I think, if you look at the economic numbers coming out of South Africa, they really aren't looking good. I think money supply grew at about 6%. That came out within the last 2 weeks. Retail sales, 1% growth. Mining production down 10% in April and 15% in the first quarter. So there's some very big negative headwinds. So you have to counterbalance these two opposing forces, low interest rates, but a very sluggish economic outlook. So I'm still relatively long, but I am maintaining quite a lot of cash at the moment, really.
So it's a cautious undertone?
Yes.
Kevin?
Agree with that. Roger, if you can just go through your investment strategy and philosophy and, how you put together your portfolio.
Okay. So I really look at it at the share price, and I look at prospects, and I'm trying to find outliers which show very good return potential relative to their risks. And I've got models which really identify this, and I want outliers, and I construct a portfolio based on my expected returns. And I've got a lot of various models which assist me and disciplines in making those choices. So, for example, I'm struggling really to find exceptional value in South Africa. As I said, with the weak economic growth outlook, it's going to be very difficult for companies to really deliver strong earnings growth. I think that people must be very cautious. Where I am seeing a bit more value, and I have got 12% of my fund offshore, is in Europe.
But still not European banks.
No, banks are very uncertain, but there are a lot of European stocks which are on 7-8 PEs. We're looking at bond yields in Germany at about 1%, and yields, dividend yields of 7%, 6-7%. And what's also very, very positive is that the institutional ownership of equities in Europe is exceptionally low. I think Allianz, I read a report that they've only got 7% of their total funds in equities. And really, if that tide turns and the sentiment turns, you've actually got this massive turnaround. You've got good valuations, the switching from bonds into equities. You've actually got the makings of a bull market. So I am looking during this weak period to up my exposure there and really try cherry pick maybe 5 very good stocks which can give me real returns of over 10%.
I think that's an interesting point. In 1978, there was a book written, and it said that the death of equities. And basically, after a decade of stagflation, he was saying that you shouldn't be invested in equities for long-term performance. And it took 4 years, but in 1982, the great bull market for equities started. And we're at a situation now in the world where just 2 weeks ago, some of the Financial Times writers were saying that they think the equity paradigm is over and they think you should be invested in bonds. And so over the last 30 years, we've almost come full circle. Now, I'd agree with Roger. I don't think we're incredibly cheap. Equities are incredibly cheap at the moment, but I think relative to bonds, they are. Yeah. And if you're an investor for the long term, in that situation 30 years ago, it took 4 years, but there was a major structural bull market for equities, and I think for the patient investor, that's...
But what happens if we see a Japan-like scenario unfolding, where equities are concerned globally? Yeah. Every territory falls into the same trap.
Yeah, I think it's going to be difficult. I think we're starting, the valuations are better value in Europe from my perspective. You know, I was looking, for example, doing research into Deutsche Börse, which is the German stock market. You know, in difficult times, it's actually performed quite well. They're buying back shares. Their cash flow is exceptional. The historic dividend yield 6.5%. And on a P of about 7.5, 8, with relatively depressed markets. So you actually do the numbers. We have a turnaround in markets. The profit should be up. And a re-rating, you can quite easily make, you know, you could make a 25% internal rate of return over 3 years if things swing in your favor. If they don't, you possibly may only make 5%, but that's not the end of the world.
True, that's not the end of the world. Well, let's look at a couple of your top holdings. RMIH we've spoken about extensively.
Yes.
Do you continue to accumulate in any dips here?
I would if with new
funds. If there were dips.
Yeah, it has actually retraced a bit. But I think I'm still willing to hold it and buy for new money. So I'm still remain positive on that.
And it is your biggest holding. And then Supergroup. At 6.8% of your fund, that's significant in the scheme of things. Yeah,
that's really the reason why it's so high. It's just performed exceptionally this year. I think it's up over 50% from day one, and that's, and I'm paring it back because that weighting is too much for a mid-cap stock. But I'm not negative on it. I just think the level is too high relative. You know, the holding is too high for the fund.
And Richmond obviously is also another holding within the group. It's something that we've discussed extensively as well. With the recent results out where it rallied some 7% on the day that it released its results, I think everybody holding Richmond is smiling and continuing to smile. The story, of course, is it sustainable?
You know, I think the spending in China, which is their primary driver, is going to continue. I read a book recently and they said, people say the Chinese have been underspending the consumer, but it's really because the economy has been growing so fast. The stats, according to this book, is that the Chinese consumer spending in real terms has been growing 9% per annum for the last 20 years. And I think that's still going to be a strong area, maybe not 9% growth, but that's over 40% of their business now. And that's a very good place to be. Just like Apple, they've got strong pricing power, which is great. And their brands are very, very strong. And a great margin. So I'm willing to hold that. I think it's a quality stock which still has good growth potential.
And David Shapiro always says that Richmond is never going to get cheap. So don't buy at your peril. Well,
you know, it gets cheap in a crisis. It was extremely cheap, but then the rest of well, I mean, in early 2009 it was trading at about 14 Rand and it's now at 46 Rand today.
I must
and got
actually
up to 52.
Pick up that discussion with David Shapiro and remind him.
But in his defense, there were a lot of things that were cheap then as well. So Mr. Price was trading at 14 Rand as well, and it's now at 110. And so when you see in a crisis, and this is what, as Roger says, you want to have some cash available, because in a crisis there are opportunities, and then even Richmond becomes cheap.
I think what's been very positive is you know, there is a crisis in Europe. You know, there seems to be a run on Spain. And the markets are very resilient. I think our market hasn't, I mean, it's barely fallen. It really is very resilient. It's up a little bit, down a little bit.
Isn't that a little concerning, though? That it's actually holding up despite this rumbling undertone?
Well, it kind of indicates the primary, you know, maybe there'll be a delayed response and it'll fall, but it seems, you know, even looking internationally, let's say Europe, which is the worst affected, that's also holding up relatively well. And that's kind of indicating, you know, the markets, it's a lot of this turmoil in the price, which I think is quite positive for the outlook. So one must be cautious about setting out too many equities. And I think what I said previously is that we've seen these crises every year. You know, the market's getting more and more immune. They kind of brace themselves for these shocks.
Shake it off and go, well, it's all going to be fine.
I think the other thing is our market is very offshore heavy. So we have a lot of very good international great companies that derive a lot of their earnings from offshore, and where we've seen most of the pain is not in the JSE coming down. We're about 6% from our high, but we've seen it in the currency depreciating over the last few weeks, or few months. Whereas if you look at the Brazilian Bovespa, they're down 20% from their high in February, but their currency has not depreciated nearly as much as the rand, and so you're seeing that shock absorber there.
Well, let's talk about the rand, because rand hedges here also, I see you are starting to look at that scenario, maybe favor rand hedges going forward. Yeah. Does that mean that you think we're going to stay at these levels or perhaps even blow out further on the rand?
I think whereas we saw a strong rand for a number of years, maybe at a premium to our purchasing power parity, I see purchasing power parity rand dollar about 7.75 and probably trading at a discount to that. But from these levels, I think we probably could firm maybe to 7.80. But we're in a kind of a weaker trading band than last year or previously, and we probably will trade at a discount to fair value. And
I know you don't want to get your crystal ball out anymore this evening. I've asked you about oil, where it's going, etc., etc. But when you sit around your investment table, where's the debate going when it comes to the local unit?
Of the rand?
Mm-hmm.
It's all Europe dependent. So
it's risk off, risk on. We're at the mercy of it.
Risk off and risk on. And as I said earlier, you need to put out your strategy and stick to it. We've also, it's hard not to get some rand hedge exposure with such good South African companies that are international operators, and so we've benefited from this weaker rand as well.
Are you bracing yourself come 17th of June? Are you waiting to see what comes out of the Greek election, or is it priced into the market? Are you going to treat it as noise and not even look at the result?
I think it's actually, no matter what happens, the market will actually almost shrug it off. The way the market's reacting, I think it's actually tired of the Greek story, to be honest. Like really, people, whatever happens, they'll go, we've written it off 100%. It's basically discounted. I don't think there's going to be a massive collapse under the worst case scenario.
Can I ask you one more question then? So let's put Greece aside, but the spike that we're seeing in bond yields, not only Spain, but Italy coming to fruition. Italy is not going to be a non-event, is it? Is it going to unfold, in your opinion? I know you're leaning to more positive, so this probably is not in your scenario planning.
Yeah.
But the news flow is not getting any better.
So I think it's a crisis of confidence, but I think they may have to look at new strategies in Europe. To try contract to prosperity, I don't think is going to work. They may have to look at more kind of expansionary policies. If you look at the debt, the government deficit in Germany, even Italy, I look in the back of The Economist and it's about 2.5%, which is actually one of the lowest of the developed countries in the world. So it's not such a crisis there, but they really need to kind of grow the base and start growing out of the debt. So I think the euro will hold together. That's my view. But
all right, well, that's a perfect positive note to close on. Roger, thank you very much for your time. Roger Williams, Centaur Asset Management.